Thanks. Okay, and I'll start us off and do some introductions, and in true Becky fashion, I'm sure people will be continuing to join us. Um, so just to give people a background on why we're having this schmooze, I was aware that we're in these months between when we had to file our 2023 taxes and when Becky is going to send out its membership bills for the coming year. And by the way, I'll give you insider information. The good news is Becky is not raising dues next year. Yeah. But I thought it would be helpful for all of us to find out about some tax advantage ways that you can pay your Becky bills, including some things I would suspect that people never thought of. And these techniques you could also use for other charitable contributions. So these experts are not accountants, and of course, it's best to discuss your personal finances with an accountant. But we hope the schmooze will plant some ideas for you to consider and discuss with your own professionals. And for sure, these matters are not my expertise. And that's why I thought the best way to approach this might be for me to ask questions. Because if the answers make sense to me, I will really trust that they will make sense to everyone. We're going to ask our experts not to use a whole lot of jargon or acronyms that are just the natural language for them, but might not make sense to everyone. And we're going to keep this recording at the website and hope that other people take advantage of it on their own time when they're ready to learn some things. So I have 7 questions. These folks have also prepared some things they think we all ought to know. And then we should have time for other questions as well. Let me introduce our panel. We have 3 Becky members who have volunteered to answer our questions. We have estate attorneys Donna Levine and Lisa Stanger, plus financial advisor Glenn Levine. Really quick bios on them that barely scratches the surface of the expertise these people have. Donna has a law office in North Haven where she specializes in areas such as trusts and estates, estate administration, and probate. Lisa, whom you probably know as the executive director of the Jewish Foundation of Greater New Haven, has a law degree in training and tax law. Glenn, who may be less familiar to you folks since he's a recently newish member of Becky, relocated to the area to be near kids and grandkids. He's been a financial advisor with Prudential, Glenn, I believe, for over 40 years.
Correct.
These people know their stuff, and we're really lucky that they all chose to join us tonight to answer our questions. So, Lisa, let me start with the first question. This is something I didn't know for years. So if I have some stock that has increased in value, I know that if I sell it, I'm going to need to pay taxes on that profit. But is it true that I can pay my membership dues at Becky with appreciated stock? And then if I do that, is it true that I wouldn't pay any taxes on it? Please let me know how this could have some real advantages for me.
Yes, Rachel. Yes, that is correct. So you can transfer appreciated stock. You would want to use appreciated stock to get as much of an advantage as you can. For the benefit of Becky, you could do this actually for any charitable organization. You would do it through the Jewish Foundation. Becky currently doesn't have its own stock account. The Jewish Foundation does this for Becky free of charge. It's pretty easy to transfer stock. It's usually pretty easy to transfer mutual funds as well. I do not recommend you wait until the last few days of the calendar year to do it, though. And that's correct. So let's say you have stock that has, you paid $500 for it. It's now worth $2,000. You can transfer it for the benefit of Becky. And you will get you will be able to claim an income tax deduction for the full $2,000. And essentially, capital gains, the appreciation just disappears. And this is a nice thing to do if you have some stock also, because you're kind of not writing the check out of your checkbook, out of your liquid assets, especially if you have a little bit of stock, maybe you're just carving off a piece of it for Becky. It's a great way to, if you have stock, if you have appreciated stock, and we'll talk also about it, if you're currently taking IRA distributions, you shouldn't be writing checks to Becky. You should be trying to use those assets to pay your Becky dues, and any other gifts that you can.
Thanks. We'll talk more about IRAs in a little bit, but let me just ask another question about stocks. And Donna, I'll send this question to you. So if I have this appreciated stock, I want to, I'm going to transfer enough that I could make a list, right? I could say, I want to pay my dues. I want to pay for Shalach Manot in advance. I want to sponsor a Kiddush. Could I do that?
Yes, absolutely. And if you're really ambitious, and let's say your stock is worth, for example, $50,000, and you say, rather than do this little by little every year, and I'm not even getting to deduct it for income tax purposes because it's not enough to warrant a deduction, maybe I'll create a donor advised fund with the foundation where I'll give the whole 50,000, get my tax deduction all at once, no capital gains, and then the foundation will hold it, and little by little you'll tell them how to spend it every year. So that's another way to do it, but if you just have a small amount, even if you have stock worth 50,000, but you only want to give 2,000, you count out the number of shares you want to give and you arrange to transfer those.
Okay, we'll come back to talking more about donor advised funds in a bit. Donna, another question for you. Okay, what if it's not as though I've got a whole lot of assets to transfer? What if it's hard for me because Becky's going to send the bills, I think in July, and then the annual campaign, I'll be asked to donate to that in October. And those are pretty close to one another. Can I work out, Donna, like spread those things out over the year? Is there any penalty I pay for doing that?
Well, there's no penalty, but in terms of how it's allocated, if you're paying it all in 1 year, do you mean?
No, I just meant the logistics.
Oh, well, for most people, and this gets into income taxes, but for most people, they're not deducting their charitable deductions anymore. They're getting no benefit for income tax purposes when they give to charity. Most people, older people particularly, because if they don't have a mortgage where they have mortgage interest, they're not. Most of the other deductions that used to be allowed are not allowed, and so people aren't able to deduct, because if you don't itemize those deductions and list them all for deduction, you get a standard amount like 12 or 13,000 for an individual, double that for a couple, even more for an older person like myself. So anyway, you get to pick between the standard deduction and itemizing all of your deductible things, and fewer people are itemizing these days. So you're not going to get any benefit from a charitable deduction unless you do it, from just writing a check. But some of these other methods at least save you from paying capital gains or other things. And now I forget what your question was.
Okay, let's stop there because you're going way beyond. You're going way beyond this. I'm really trying to focus on.
Well, it's a question of
little piece questions, just so that you don't lose us. Okay, but one thing I do want to point out, in case people don't realize this, but I want my panelists to correct me if I'm wrong. If I understand correctly, tuition for religious school, if I understand properly, is not a charitable deduction. Am I correct about that?
Well, that's what Peggy put on my, statement this year, that was not listed as charitable, but I suppose everything is questionable. If you're getting value for it. So if you just sponsor a Kiddush for the congregation, you're not really getting value. But if you buy something at the gift shop, you are. So if you're getting value, it's not a charitable donation. So it's a question of, is religious school of value?
I think the issue is whether we could argue, and this is beyond this, whether it's spiritual instruction. Because if it's spiritual instruction, then often it could be considered tax deductible. But that's really sort of beyond this. But yeah, there are probably things you do at Becky that you pay for at Becky that are not deductible, but certainly your dues, your annual gift, every tribute gift, different things, Mashal Manot, Kiddush, those are all deductible. And yes, you could arrange with the office to send money at different times during the year or send it all at once and have Peggy hold it. So the example Rachel was given, if you send some stock and you're like, oh, this is, going to pay right now for my membership, and I'll decide what the annual, she can apply it during the year to tribute gifts and other gifts. And maybe you'll even have a credit for the year after that. If you haven't, or maybe there'll be so many things you want to give to a Becky and you have so many simchas in honor of, you'll run out and you'll have to send more stock.
Thanks. Glenn, I have a question for you about something that I believe is called bunching, where if I want to, front load all my charitable giving in 2024 and then not in 2025 so that I can pack in more of my deductions for 2024, there's something known as bunching. So Glenn, then could I pay 2 years worth of dues to Becky? How does bunching work?
Well, getting back to what Donna was saying earlier, the vast majority of people are not itemizing their deductions. So, a couple of $1,000s in charitable deductions is usually not getting you a tax deduction over and above what you would get from a standard deduction. So what some people will do is, and I assume Becky would allow this, is to pay more upfront and sort of put it on their tab, if you will. And maybe in doing so, they've got to the point where now they have a charitable deduction that exceeds that standard deduction. So bunching, putting more upfront, paying a couple of years would allow them to do that. Maybe another way to do that is getting back to what was mentioned earlier, which is using a donor advised fund, which they can do through the foundation, where you might say, okay, we're getting no benefit from our charitable deductions, and we have the cash or the appreciated stock or some other method of being able to use a donor advised fund, put 3 or 4 or 5 years worth of charitable contributions into that donor advised fund, and then over the next several years, spread that out over whatever charitable contributions they want to make. So they've made they get the charitable deduction by putting it into the donor advised fund, but until it's actually given to the charity, it's not credited to that particular charity.
Thanks, Glenn. You entirely anticipated the next question I was going to send to you. So Lisa, if I want to send up a donor advised fund, and just so everybody understands it, I send that money into the fund. It can only be dispersed to charitable organizations, but it can be dispersed over years. But the year I put it in, I get to take that big deduction. So Lisa, is there a minimum I would need to put in to set up such a fund?
Yeah, so generally the minimum is 10,000. You could do it over several years. And we're very flexible with that. We've had people who don't want to commit to a donor advised fund, but they want to make stock gifts to multiple organizations. We set up a temporary donor advised fund. Maybe they send us a few thousand in stock and then we distribute it as they want. As long as they're willing to comply with the donor advised fund rules, which are they're IRS rules, they're not foundation rules. It has to be a US based public charity. Then we certainly can help them with that. So the reason someone might want to do it is, again, they need help with giving stock to multiple organizations. That would be kind of hard to do on your own if you wanted to give, 500 here, 1,000 there, 2,000 there. Many organizations can't get stock. Pass it through the foundation, we can help. They want to start saving up money, into a fund to make charitable gifts. They want to bundle, so that they can get over the standard deduction amount so that they can deduct it, especially in a year. Let's say they have a year where they have some sort of tax liability. They sold a business, they had to take a distribution or something, and now they have a lot of taxes in a given year. Put the money all towards charity in that year, and then you can decide over time how to use it. You can also do that same thing specifically for Becky. You can set up a Becky endowment by bundling in gifts when you want to send a lot of stock, or you want to get a large deduction in one year, or even a Becky donor advised fund. It's called a field of interest donor advised fund. You say, I'm setting something up for Becky, but I don't want it to automatically give money every year to Becky. I'm going to, decide, this year Becky needs money for heat, and, the next year Becky needs money for education or something. So that's something you can do with your bundled gifts as well.
And just to clarify, even if, and then I'll let you speak in a moment, Donna, but just to clarify, even if I set up the donor advised fund with a Jewish foundation, I could be giving to non-Jewish organizations.
Absolutely. Yes.
I could give to anything as long as it's a 501c3. It's okay.
Yeah, it has to be a US-based public charity, which includes American Friends of Organizations. So most Israeli organizations have American Friends of, but we can't give to a foreign organization. We can't give to a private foundation.
Donna, I cut you off. There was something you wanted to add?
I would just, when you talked about, Lisa said giving for heat, I just said, heat, what's that?
Yeah, we'll get heat
gonna
back
have
just around the point we won't need it anymore. Donna,
Yeah.
let me ask you a question. Switching gears now from assets I have available now. Now I want to think about leaving a legacy to Becky. So if I want to be on that list, I want to be honored at that annual Kiddush. I want to be considered a legacy donor to Becky. Okay, so let's say I have a will I set up years ago. I don't want to spend time and money back with that attorney, changing it to say, I want to leave some money to Becky when I die. What are my easy to do options, like about adjusting the will, and also about, if you want to also mention, like, would an easy thing be, like, I could say on my life insurance policy that I want some of that to go to Becky? What are some easy options that I have that won't be expensive and take hours of my time?
Well, probably the easiest for a Becky member, but not necessarily for me, is to just ask me to do a codicil, an amendment, or because I won't charge for it if it's for money to go to Becky. Although usually, because codicils, they call them, it's like an update, an amendment. It's like a separate piece of paper. Usually nowadays with computers, we just want to redo the whole thing with the new clause. But in any event, I wouldn't charge to do that, to add a bequest to Becky. But beyond that, the best way, yes, as you mentioned, is to name a beneficiary if you have the kind of asset like insurance. Even on life insurance, you could, so let's say you have $100,000 life insurance policy, you could name as beneficiaries, $5,000 to Becky and the remainder to my children equally, or something like that. Some organizations, they have their own rules. There's nothing against the law about doing that. Some organizations say, oh no, it all has to be in percentages or this or that. But that's, you can go to a different organization if that's the case. Same is true with an IRA or any retirement account. And that is the best way tax-wise, because anyone who inherits any person who inherits a retirement account that hasn't been taxed during your life, that you put aside, and as you take it out, you pay tax on it, doesn't go away at death. Whoever, if your kids inherit it or whoever, they're going to pay tax at their own bracket when they inherit it. And often it's just right when they're at the peak of their careers and earning the most. So a really good way to leave money to a charity, specifically Becky, is to name Becky as a beneficiary or a partial beneficiary on a retirement account. Again, some organizations only want a percentage, but I did check it out because Lisa and I talked about this, and there's nothing wrong with naming a specific amount. and the remainder to children if the organization will let you fill out the form that way. The because for Becky's sake, I always wonder if you've named Becky as partial beneficiary in a retirement account, but then that retirement account gets used up before you die, Becky might get nothing. I very often encourage people to put a clause in their will that says, I leave whatever it is, $5,000 to Becky, less any amount paid directly from my retirement account. So if there was no retirement account, we'd still get something. But that's just a pro Becky move. But basically, naming a beneficiary, and I can help people fill out forms to do that. I'm sure Lisa could too, if really anybody could, because they do make the forms confusing. But you just send to your insurance company or your IRA or whatever that asset is, and put Becky on as a beneficiary.
Thanks.
Even just 1% or 2% is often a lot.
Now, in case anyone didn't hear it, Donna's voice sort of dropped as she was saying it, but what she was saying is that she would do any of these things for free. So she, in fact, did that for me for my will. She created a codicil for my will, so I didn't have to go through all those agonizing questions of what do I do if my, if this person predeceases me and all that. Anyway, and she would do that for free. Glenn, let's talk more about the advantages. So if I have different assets that I could leave part of something to Becky. And so what I'm hearing Donna say is that my IRA, we're not talking a Roth IRA, we're talking a regular IRA, that would probably be the best way to leave money to Becky because it could actually reduce the tax burden for my son who's going to be inheriting it. Glenn, can you explain just so we can all understand why that money would be the best to have come to Becky?
Yeah, thanks. I think that's an important question when you think about the hierarchy of bequesting or bequeathing money to a charity. There are some assets that are going to pass to your beneficiaries tax-free. And when I say tax-free, I'm talking about income tax-free now. Estate taxes may be a different scenario, but in speaking of income taxes, IRAs money or qualified money that's in a 401k plan, that's not going to go to your beneficiaries income tax-free. As Donna said, they're going to be taxed at that, and it may be at their highest earning years. The IRS changed, and not only that, but they changed the tax laws a few years ago so that what used to be able to be stretched out over a beneficiary's lifetime, now, unless it's a spouse, has to be taken over a 10-year period. So the IRA money is going to get taxed to your beneficiaries. Funds that are in an annuity that maybe it's not an IRA, but in a non-IRA annuity where you have a cost basis, but you have some earnings that have not been taxed, that would be maybe the next best thing to make as a beneficiary, to have part of that go to Becky. Most other things, well, I'll put savings bonds in there as well, although that's a little bit more complicated to choreograph. Savings bonds have interests that have built up in them, and your beneficiaries will pay taxes on those savings bonds. But there's a way to, I believe in your will, to leave those to a charity if you want that to happen. You can't retitle them, but you can leave them. But things like stock that's appreciated and life insurance proceeds, your beneficiaries are going to get that on a tax-free basis regardless, because with appreciated stock, your beneficiaries are going to get a step up in basis, which means that whatever the value is on the day that you die is what their cost is for that stock. So they sell it the next day, they don't pay any taxes on it. And life insurance policies, by their very nature, as long as they meet the definition of life insurance, are income tax-free to the beneficiaries. So IRA money, annuities, maybe savings bonds, and then if you don't have other assets, stock, life insurance, savings, those would be the next things in order.
So,
I just want to go back to one thing about the appreciated stock, because some people might have a sentimental attachment to the stock that they're giving away. The IRS does not forbid you from donating the stock and buying the stock the next day. There are no such thing as wash rules when it comes to stock that's being donated. So if you really have a sentimental attachment because your parents gave it to you or your grandparents gave it to you and you really don't want to gift that, you can gift it and buy it at the same time and still own that stock.
thanks.
And now your cost basis is what you paid for it, not what your grandparents paid for it.
Thanks. So just to circle back for anyone who's still trying to wrap their head around why IRA money is the stuff that should be donated. So if I make the comparison of why that, so the reason to be donating that is that your kids would be paying such a high level of taxes on it. So that's the stuff that most readily can go to Becky or whatever charitable organization, and the charitable organization pays no tax on it. They just get it. And by doing that, that actually reduces that amount of the estate.
So Rachel, if I may,
Yeah.
a few people have objected, but I call the IRAs and 401ks and that kind of thing your dirty money. And then maybe you've got clean money. Your clean money is not going to be taxed when you need to spend it. Your IRA or your 401k, when you pull that out, either for yourself or when you die and somebody gets it, the IRS is going to get a big chunk of that, and the state of Connecticut. So that's like dirty money. And so I said, I just use that clause and I say, well, give your dirty money to charity and keep your clean money. That's just sort of my way of thinking of it.
And to make those decisions, I can either add it to the paperwork of my IRA, whether I'm able to do that online or there's paperwork to fill out, which you would help me with, or I could just leave those instructions to my children because they might not be savvy enough to know that that's where they should be giving. In other words, or your sense is in the codicil, it should say that that's where the money should come from, or can I just say that like 10,000 to Becky, and I just leave instructions to my kid that that's where it should come from? Or does
I'm
it
not sure that will
in
work.
advance?
We have an accountant lurking here, Harold, but I'm not sure that would work. Because unless the charity is actually named on the account as a beneficiary, the estate is going to take in, if it's named to the estate or to your child or whoever, they're going to take in the income and then it's going to get spread out amongst the various beneficiaries, so I don't.
With retirement plan assets and with life insurance, you really need to use the beneficiary designation form. It should not be through your will. It should not be going to someone who's then going to decide for it to be done properly and work tax-wise and work like you want it to. You need to fill out that beneficiary designation form. And the other thing I want to mention, at passing, you can do this with IRA, 401k, or 403b. So that's a little different from, we'll talk about in a minute, current giving from your IRA, if you're 70 or half or older, which can only be from an IRA, but at your passing, IRA, 401k, or 403b, piece of it or all of it can be left to charity. If you have a surviving spouse, you want to leave it to the spouse. Makes sense tax-wise. This is really when there's no spouse, no surviving spouse, or there never was a spouse, or legal marriage partner. Then when it's going to non-spouse beneficiaries is when they have to take it out within 10 years. They have to pay income tax on it. And that's why that's really an asset that you can really think about leaving a chunk of it to charity through the beneficiary designation form. You can
Okay.
also, yeah,
Exception
So-
for a disabled child or a chronically ill person or a person less than 10 years younger than you. Those
Okay,
are-
so
that they
point-
get taken out over a slower period.
So point is, that's not an instruction you can
Longer.
leave to your children because it will be viewed as theirs. They're going to get taxed on it, and the opportunity to have left it to Becky will be gone. So it's essential that we designate that, we having that asset, knowing that's the best way to leave something to Becky, and do that in the beneficiary designation. Got it. Understood. All right. Let's shift to matters for older people or people who have parents who are older in the category of where people need to start in their IRAs and start paying, start pulling out required distributions. And Donna touched on it earlier. I'll turn back to her for more about that. If I'm at an age where I'm required to take distributions, we're going to talk about how that money can go directly to a charity, and therefore reduce my taxes on that. Donna, would you explain how people do that from IRAs?
Yeah, but first, before that, I just want to say that they have raised the age at which people, and they're continuing to raise the age at which people have to start drawing from their retirement accounts. It used to be 70 and when the year that they turned 70 and a half. Now this year you have to be 73, I believe, and it's going to go up to 75. But what they never did change is the age at which you're allowed to give it directly to a charity and not be taxed on it. That remains at 70 and a half. So even if you're 71 and you don't have to take it out for yourself, you may choose to, because again, it's your dirty money. It's going to hit you someday that it's going to get taxed. So if you have to make a payment out of, your clean money or your dirty money, you can use your IRA. But that's just to distinguish the age. Certainly when you reach the age where you have to take it out in increments, it's a life expectancy table. The first year you take out about 4%, then it's a little more and a little more. Anyway, when you do have to take it out and you have to pay taxes, there's even more incentive if you to use that money in a way that you don't have to pay taxes. So you have to pay it. The rule is that for it not to be counted as taxable income, it has to go directly to a charity. Once you take it, if you've got your account at Fidelity or Bank of America, wherever your retirement account is, they're going to send at the end of the year a 1099, a tax statement saying, your social security number got that money and you're going to pay tax on it. So you have to be careful how you do it. If you want it to go directly to a charity so that you don't have to pay tax on it, you really have to talk to your financial institution about what they'll allow. Some of them you have to call them and ask them to cut a check to Becky. Some of them you can do it online. My favorite way is, which is what I do now, is I have a checkbook connected, draws right from my IRA. And so when I want to write something from charity, I use that checkbook all year long for any charitable amount. My company allows me, I don't do too many, but $18, whatever it is. Sid's retirement account's in a different place where there's a minimum $250 when you write a check. But whatever your financial institution is that's holding your money might have their own policies. But legally, you can write checks throughout the year directly to charity. And then if there's still an amount you have to draw, because once you reach that, you can do that, by the way, at 70 and a half, even though you don't have to take anything. Once you reach the age at which you're going to be required to take money, you're going to be told at the beginning of the year, shortly after the beginning of the year, how much you have to take. It's based on what the value of your retirement accounts was on December 31st. And then they apply the life expectancy table. So if you're told you need to take $20,000 out next year out of your IRA or a retirement account of any sort, and you start writing checks during the year for your Becky dues, your contribution, whatever, and you spend like maybe 12,000 on charitable, then sometime in December you take out the other 8 and pay tax on it. So I like that way of being able to do a check. The thing to be careful is if you do call the company, and I know a lot of companies do this, and you call and you say, write a check to Becky for, $1,800, and they just mail it to Becky, they don't always put your name on it, and it gets really confusing. So my great preference, if you're going to do that, is tell them, write a check to Becky, but mail it to me. I'll send it with a note, so long as it's not written directly to you. One of my pet peeves in life is that you can't like charge things. So something like the Great Give or something that only does it with MasterCard and stuff, it's very hard to give from your IRA. You could pledge and say you're going to give it and then give it directly from your IRA. But if you charged it, it's like money coming back to you. So how you arrange it depends on the financial institution. I'm happy to help anybody with that stuff. The other thing that you should know is because, well, let's say you do deal with Fidelity. Fidelity doesn't want to know whether these were legitimate charities or not that I had to write checks to, or that I wrote the checks to. So at the end of the year, I'm still going to get a tax statement saying I pulled out $20,000 or whatever the amount is. They're not going to distinguish between what actually went directly to charity and what went to me. So you want to make sure you keep good records, either copy the checks before you mail them out, or certainly you should be getting something from the charity confirming the gift. But anyway, when you go to do your tax return and you have this thing from the IRS saying 20,000 came out of your IRA, whoever does your income tax return will put in amount QCD, qualified charitable distribution, subtract off 12,000 that went directly to charity, and you're only taxed on 8.
Thanks.
Well,
Len, a
that's the
sidebar.
mechanism, but the thing that's really good about it, aside from the fact that if you're paying out of your IRA, it's just not taxed. Whereas, as Glenn said, most people aren't itemizing deductions. They're not getting any benefit for their charitable deductions. So this way, you just don't even get taxed on it. And because you don't get taxed on it, doesn't appear on your return, you don't pay any state income tax, which just goes by the federal level. And you may even avoid having a higher Medicare premium, which is as income levels go up, may, for people at lower levels, may avoid being taxed on your Social Security because that only is at certain income levels. So, having it not appear on your tax return by taking it out of the IRA and then giving it to charity can be a huge boon for anyone 70 and a half and over that has any money in a retirement account or an inherited retirement account. Those work too. What doesn't work, by the way, this is very important because I learned it the hard way. You can't make an IRA charitable rollover directly to a charity, non-taxable, out of a 401k or 403b. You have to get it out of there the year before because the charitable amount is limited based on what was in an IRA. I don't know why they distinguish, but what was in an IRA on December 31st of the prior year. So the first year when I turned 70 and a half and tried to make a charitable distribution, they said, but all your money's in a company retirement plan. You can't do it. And so then I rolled it out, and the following year I could. So I warn anybody that's about to turn 70 and a half, you have to count out the 6 months, get your money out if you can, and if you want to get your money out of, or a big chunk of it out of your company retirement plan into an IRA, which is easy to do usually, and except if you work for Yale. They make it much harder. But anyway, so that you're eligible for the IRA charitable deduction when you do turn 70 and a half. That was a lot, but
Thanks, Donna. Let me put a note on that. The issue that Donna referred to with Yale, it's not about Yale, it's about TIAA-CREF. And the
Exactly.
fact that those plans are called 403B or whatever the numerology is, and they don't have that option to do charitable donations, but you can roll it out of, no, Steve, you're shaking your head no, but I'm living the dream here. Yeah, anyway,
You were
so
on mute.
Steve, what is it you're trying, you manage.
403Bs and 401Ks. Yeah, you can't do it with a 403B or 401K. TIA-CREF as an administrator in general is not easy with these sorts of things. That's a whole separate issue.
Yeah,
So you
They're all
can, in
different.
those cases, roll over, if you are now retired and no longer working, a 401K or 403B into an IRA. TIA-CREF is an administrator that is a little more difficult in working with on that.
right. So you roll it over to something from
If
which.
you have something else, go
charitable.
off mute and tell us what you want to say.
Steve, go ahead. Steve, you need to unmute.
Okay. Every year I send TIA a list of my charities and the amount I want to give with the addresses. And every year they send a check to whatever the charity is, including Becky, where I'll pay for my dues, my contributions to anything, and I never have a problem.
From a 403B?
Or is it
From
an IRA?
it's from a couple accounts that have a required minimum distribution.
They must be IRA accounts, though, not 403.
Maybe, I don't know.
Yeah.
Yeah.
But they don't have a problem with doing that.
Yeah, it's
Yeah.
all in the nature of the account. I shouldn't be
Right.
throwing mud at TIA in general.
Or at Yale.
And it's certainly, Yale's just one of many
Yeah.
places that uses TIA, but you have to check on the nature of your account as you
Right.
start getting towards that age, just to see. I want to turn to Glenn for more clarification about the advantages that Donna made reference to of when you send money, you send distributions from your IRA to charities. Eric, did you have your hand up because you needed to do some housekeeping?
No, I have a question because I want to make sure a point didn't get lost. It's a question, just to clarify, because Donna packed about 5 answers into one question. Were you saying that when you have to start taking required minimum distributions, that any contributions you make to a qualified charitable organization will count towards that RMD?
Yes, up to $105,000 a year.
Okay, well, and that's once you're 70 and a half or older.
Well, you don't have required minimum distributions at 70 and a half anymore.
Well, okay, in my case,
But-
73.
Yeah.
Okay,
But
so when I have
but,
IRDs, I can actually direct some of it and get a tax benefit for that. That's what you're saying.
your tax benefit is that you pay no tax on
No,
it
no, I
instead
get
of
it, I
having to
get it.
pay tax. Right. Right.
I mean, one other side question, I was curious, if you got drug money that you want to donate, what do you call that? Because you're already calling these IRAs dirty money.
Eric, we're gonna let
You can move
go
on now.
back to
I call them
managing.
tax smart and tax plagued assets, and that's
Ah, okay.
So Glenn, just to clarify a little bit more. So when I take a distribution from an IRA, a regular IRA, and it's all taxable income, if I give some of it to charities, Donna made reference to it, but I'd love for you to talk more about it. It has multiple advantages as far as reducing my income with Medicare and Social Security. Can you explain that a little bit more just to make that really clear to people?
Sure. So, again, going back to what Donna said, if you're either 70 and a half or older, you can have those distributions directed straight from your IRA account, which would otherwise be taxable money to you, to the charity. And the mechanics depends on the institution. I like the checkbook approach myself, that, for people that they write their own check, their name's on it. There's no confusion about where it came from. Again, the advantage of that is multiple. Those dollars coming to you take away from the amount that you have to take as a required minimum distribution. They count towards your required minimum distribution. They're not taxable because, while it shows up on a 1099, it comes off on the line that you deduct away from it. So, if you take 10,000 and in a required minimum distribution, and that all goes to the charity, then there's zero taxable that shows up on that taxable line. But getting back to what Donna was saying was with the other fringes, which are, there are other parts. If you were to take that distribution, and then even if you got an entire write-off from it because you were itemizing your taxes, it still shows up on what's called modified adjusted gross income line. And for many people, that determines how much premiums they pay for Medicare, and it might impact the taxable nature of your Social Security. So keeping that off of the taxable line or the modified taxable line, to get more complex, it could be sort of the unknown advantage. But the big advantage is that those dollars are going directly to the charity. It's as if, even though, there's CPAs have to do their work to put it on the return, even though it shows up there and then it gets taken off, it's something that never shows up as a taxable event to you. And ultimately, those are dollars that from your beneficiary standpoint, that if they're left in that account, they're going to pay taxes on. So save your cash dollars and your other dollars and use your IRA to make those contributions.
Glenn, one additional thing, I know you haven't been in Connecticut that long, but in Connecticut, they don't allow charitable deductions, even if you have charitable deductions on your federal return. But if you never reported income on your federal return from an IRA because it went directly to charity, it doesn't show up on your Connecticut return, and therefore you avoid like a 6 or whatever % Connecticut tax on that income as well.
Lisa, I have one final question. Sometimes it's overwhelming to figure out how to invest my retirement money. So I understand that I could set up a charitable gift annuity, and that could generate income for me during my lifetime. And then whatever I didn't use up during my lifetime, I could leave to Becky. Could you explain charitable gift annuities in general, and specifically what's the minimum amount to set up one through the Federation? Is it through the foundation, the Jewish Foundation, I should say? Is it a good investment? What advantages does it offer?
Okay. Yeah, so charitable gift annuities, and there are actually a number of people, so Rabbi Levine likes to talk about, he's done a number of charitable gift annuities for the benefit of Becky. And interestingly, for some reason, people who do charitable gift annuities actually usually live beyond their actuarial lifetime. So as you can see with Rabbi Levine, but after 120, when he passes, if there's money left in his charitable annuity, because he's living past his actuarial lifetime, it will come to Becky. So a couple of things. So a charitable gift annuity works a lot like a charitable, if people are familiar with charitable trust, but you can do it with a lot less money. It's a lot easier. You don't need a lawyer. You don't need to do tax returns. Charitable gift annuity, you make a donation. In this case, would be to the Jewish Foundation. Based on your age at the time of your donation, you get a fixed amount of income each year in return for that donation. So for example, let's say someone gives $10,000, and let's say the rate based on their, and you really need to be over 70 for it to work. If you're younger, usually the tax advantages are, the IRS won't allow it because not enough is going to go to charity, but it really depends on the rate of return. Let's say the rate of return at age 70 is, 5%. you would get, $500 a year, part of it's income tax free. But you name the Becky or whatever charity to get the remainder. Now, they only get what's left in the annuity. So you might end up living well past what the IRS considers how long you should live. You'll still get the payments. Actually, the foundation loses out. Of course, we don't lose out because the person lives, and that's wonderful. But in terms of, monetarily, we do, because we have to keep paying that money. It's a contract. We keep paying them that annual amount. But it might mean that there's nothing in the end left for charity. We had people who, a few who died before their time, and there was quite a bit left for charity, and then that goes outright to charity. The tax advantages are when you set it up, in addition to getting this guaranteed income in return, you do get a tax deduction. Now you give 10,000, you don't get to deduct the whole 10,000 because you're getting something in return. Again, there's a complicated calculation. We have special software for this, but it says, based on how old you are when you make it the gift, what your rate of return is, what your income's going to be, what the, estimate is that will go to charity, and what you can deduct. In terms of a good investment, it really depends on your age and rates. Many years ago, when rates were higher, lots of people like doing the charitable gift annuities because the rates were much better than they could get through general, CDs type of things. Then for many years, with interest rates being so low, the rates were pretty low. They were less popular. Now the rates are getting better. Is it going to be the same rate of return you might get long-term with stock or mutual fund? No. Is it going to be better than what you can get from a CD? Probably, again, depending on your age. But you also get the income tax deduction, you get the guaranteed income, and you get to make, a charitable gift with what's left in the end. And also, we were talking before about IRAs. You are allowed to use up to $50,000 from your IRA, assuming you're 70 and a half or older, to establish a charitable gift annuity. So you could actually do it rather than from your general savings. You could do it from one time from an IRA.
Great, thank you. I've run through all of my questions. I know the panelists had some notions of what they thought we needed to tell everybody about. Are there other things, panelists, that we did not touch on that we ought to make sure?
I feel like we got to everything. I just want to emphasize, a couple of, summary. We talked about appreciated stock for giving, qualified charitable distribution from an IRA. When you think of your retirement assets, during your lifetime, once you're 70 and a half or older, qualified charitable distribution from your IRA to make charitable gifts rather than taking that distribution. Really for any amount. There are people who don't need that income from their IRA, and certainly they're going to give it to charity then. There are people who do need the income, but if you're making a charitable gift, it's tax advantage to do it from that. But when you're living, it has to be an IRA to do this with. So if you have a 401k, a 403b, you can look into whether you can change that to an IRA. When you pass away, again, retirement assets, really good way to name a charity, to give money to charity, and that could be from an IRA, 401k, or 403b. And then Glenn, I think we touched on a little bit, if you want to add a little bit more about life insurance and some other ways to give.
Yeah, I mean, life insurance is, people think of life insurance as a convenient way to change a beneficiary and make part of it to a charity. I've also seen, clients that have actually outright gifted their life insurance policies to charities where they change the ownership on a policy and gift it to the charity, and then the charity can decide if it's got cash in it, whether they want to surrender the policy or continue paying the policy or do a combination of both. But going back to what I was saying earlier, if you're strictly talking about the tax efficiencies of bequests, then utilizing IRAs or annuities that have earned interest built up in them, those are the most efficient things to name a charity as a beneficiary rather than the life insurance that would automatically go to your beneficiaries, income tax free. So while there's advantages in the ease of using the life insurance policy, there may be more tax efficient ways to doing something else. And that's where everybody should talk to their own tax advisor about, or their estate planner about what's the best thing based on our situation, what our goals and objectives are, what our charitable inclinations.
Thanks, because just so that it makes sense to me and to everybody else. So if there was $10,000 I was going to leave to Becky, if it comes out of the life insurance, that's $10,000 my kid would have gotten. But if it comes out of my IRA, that would not be $10,000. That would be
Yeah.
$10,000
It-
minus the tax hit.
Correct.
It's so.
And the other thing is, I think Donna had mentioned earlier that if there's nothing left in the IRA, then obviously that's, that's a concern. I mean, if you really want to designate a dollar amount for a charity, what you could do is to set up a separate IRA, put a certain amount in that particular IRA, name the charity 100% beneficiary of that IRA. And as long as you don't live to 120 and are forced to take the required minimum distribution out of it, which might deplete the entire IRA, then you'll know that there's an account there with that charity's name on it.
Because you could take your required minimum distribution from your other IRAs, your required minimum distributions from your total IRAs, but you don't have to take a piece from each.
Right.
One other thing I want to say, I think we really covered all of the tax issues we wanted to discuss, but I do want people to know if they are planning a gift to Becky, we do currently have a policy that goes along with the foundation's policies that if you give 10,000 or more at death or during life, you can set up a name fund. You can name it after yourself or your dog or whatever, and have your own fund. We have a number of those at Becky. If we do get a bequest from somebody that it is less than that, we have a policy that at least half goes into endowment, depending on our needs that year, but at least half goes into an endowment fund we have at the foundation called Legacy L'Chaim, and so that it doesn't just disappear down into our operating account. And the foundation pays us out an annual income this year. I mean, you'll hear if you come to the annual meeting. This year we got about, I think it was 175,000 almost from our endowments. We're doing very well. That's the only reason we're solvent.
Yeah, 175,000 just from the Jewish Foundation and Becky Endowment.
That's right. We have some endowments at the Community Foundation, but much less. But and they have similar policies. So that income is keeping Becky afloat, really, because I've been a member 40 some years, and I remember many, many years where every year we were borrowing at the end of the year from members, from banks, from whatever, to get through the year. And we haven't had to do that in about, I don't know, 8 or 10 years anyway. And Steve, you may know more than that. Yeah. And it's because of the endowment money filling in that gap. So we really, that's why I'll do it for free, because I know it's really going, if people will do that and make those bequests either lifetime or at death, and then you get your name on our Legacy L'Chaim donor group, and you get to eat a little extra at the Kiddush, whatever.
Yeah, just to give people a sense of how much at Becky we're staying in the black because others before us took the time to have Donna or somebody write the codicil, who've made the arrangements. Steve will correct me if I'm wrong, but I believe that our endowment income is 20% of our annual budget. It's an important component to it, because our dues only cover 45% of Becky's expenses per year. So, if we outlive all of our assets and there's nothing to leave to Becky, so be it. As Donna mentioned, that we can designate funds, if they if they still exist. But if there's money that we still have upon our demise, and we don't feel that our children need to have every penny of that, it's a really important gift to Becky.
I just wanted to take one moment to talk about the gift that I thought was very special this year that's sort of half paid in, but Charlie Ludwig, I don't know how many of you knew Charlie, maybe most of you. Charlie always wanted, because Jay Sokolow was so good to him and helping him with all his medical over the years, he wanted to compensate Jay. He wanted to buy him a gift. He wanted to do something, but Jay would never take money or anything. And Charlie, actually, I'm proud, it was my suggestion, but he ultimately established a fund for Becky. He gave $10,000. It was like the week or two before he died. And Lisa helped get it put together really quickly. And it's a Becky, it's the, I think it's named after Violet and Charles Ludwig Fund in honor of Jay Sokolow for Becky. So that got $10,000 then. And I will say, in Charlie's will, I'm his executor, and we're just about to distribute an additional $33,000. That is because he divided up, he didn't have children, he divided up his estate among 7 people, his 6 nieces and nephews, and Becky was the 7th in equal shares. And so that's what it came to. And Charlie was not a rich guy, but he was able to do this, and he'll have a legacy for the rest of eternity.
So we're ready to take questions. Eric, you have a question?
Yeah, again, just to fill in a blank, there's discussion about assigning beneficiaries in various ways through your institution. Like I've got a Fidelity account. They make it very easy for you to identify who your beneficiaries are and what percentage they get. And then there's your will. Do you have to have any coordination between those two? I mean, if you change a percentage or something, or you have an additional beneficiary, do you also have to have them named in your will? Or is there one that automatically legally takes precedence over the other?
Should I answer that as the beneficiaries always, or joint owners or any other designation of another person on an account, always takes precedence over a will. The will only covers things that don't have a beneficiary or a joint owner. So you do need to coordinate. And like I said, if you are afraid, if you really want to leave money to Becky and you've got them in your as a beneficiary of your IRA, but you're afraid your IRA will get used up before you die, you might want to put something in your will that in the event they don't get enough from the IRA, then you leave them X dollars, which is sort of a cautionary thing. But yeah, and people don't know that. And bank tellers will tell people, oh, you got to put another name on your account, and they put their friend's name on their account, and that walked into the bank with them, and then their friend inherits it. No matter what I've had that happen. $80,000 to someone who drove her to the bank. And we had difficulty proving that that was not the intent. The law just changed, actually, just this month, effective in, I think, October, that, to prove that that wasn't intended to go to somebody else on a joint owner. It's no longer, you don't have to have what they call a preponderance of the evidence. You just have to have a little bit less evidence, something, or I think they changed it from clear and convincing to a preponderance. Anyway, it's a little easier to prove, but on a beneficiary designation, I've had money go to ex-wives because they never changed their beneficiary. In Connecticut law, we're trying to change it, but even a divorce, if you divorce says you get the house, but you never change the name on the house, too bad. It goes to whoever's name is on it, your ex-spouse or whatever. So beneficiary and banks and financial institutions are all too casual about beneficiary designations, with all due respect, Len. that because people often don't know. Oh, yeah, I named my mother when I first took that out, but she died 30 years ago. I don't know if I updated it, So you got
I speak to a lot of policyholders that our company will ask us to call on who had policies years ago and haven't spoken to an agent or advisor. And one of the first things we do is talk to them about the beneficiaries, make sure that they're up to date. So anybody who has either old designations on IRAs or life insurance policies, it's a good exercise to just review them from time to time to make sure that they're what you want them to be.
Thanks. We've got a couple questions lined up. Seth, please unmute and ask your question.
Thank you. This has been really great. Thanks all of you, to all of you. A quick clarification. So if someone on the younger side, too young to take RMDs, it were to inherit part of an IRA from an older family member, the person, and I'm hoping that doesn't happen anytime soon, but you know, a person, so we'd have 10 years to deplete that. Can, during that depletion time, can any of that be used in this way to make non-taxable contributions, or do you have to be a certain age in order to do that?
You have to be a certain age. Yeah, you have to be 70 and a half or older.
Okay, so it's all got to come out and get taxed.
And it's within 10 years, so you could do it all in year 1, all in year 10% a year for 10 years, but at some point, one thing is certain, you'll pay taxes.
Okay, thank you.
Yeah, if you're going to be 70 and a half, like in year 10, you can sort of take as little as you need to. There's actually very complicated required distributions, even in the interim years, but they waived it for the last few years and for the coming year because they haven't made regulations yet. I just went to a seminar on this yesterday, and that's why I late for the board meeting last night. But very complicated rules on these things. And like I say, there are exceptions to the 10-year rule at death for a spouse or for a child with a disability, or a trust with a child for a child with a disability, a chronically ill person, a person less than 10 years younger than the decedent, all of those people, or a child under 21, all of those people get a longer period to take it out. So, but there's no regulations. This was a law that went into effect for people dying after January 1st, 2020, and it was passed in December of 2019, and they said, okay, they'll make regulations clarifying those rules, and then COVID hit, and they never made regulations. So there's still a lot of confusion about those deaths, but you know, how quickly you have to take it out. But none of us die until they get these regulations, so that we're okay.
Debbie, let's let you ask your question.
It's not a question, it's actually a comment. So, hi everyone. What I wanted to let you guys know is that my grandfather was a CPA, and I don't think I was around while he was working, and if he was, I was extremely young and just had no, recollection of it. But my mom has told me multiple times that my grandfather was a CPA.
You have this in your blood. You've inherited. You've
Yes,
inherited
but no.
connections with our
I
people.
am far away from being a CPA, far away, but still very thankful for what my grandfather did.
Thank you, Debbie. Steve, a question or comment, please? You're muted.
Just a comment. We talked about taxes and the way to avoid taxes if you can. And my take was the best thing to do if you're taking from a required minimum distribution and you want to give to a charity is have whoever's running your distribution pay directly to the charity. Therefore, your name is never on a check, and it's never, you don't get a form at the end of the year saying you got to put this in as a qualified distribution. And to me, that's totally clean.
I mean, you're correct, but it's just as clean if the institution will let you have your own checkbook, so you write the check. And Lisa has told us of incidences where they had trouble identifying a check received, who it was from, or a stock that was an appreciated stock, going back to that. And, the foundation receives it, but it's not clear whose it was. And, so if you rely on these financial institutions, you're relying on the financial institution to do it right. So there are a number of ways to do it that all work, and whatever works best for you.
As long as you make sure that the money isn't coming to you, because once it touches you,
Right.
it's no longer tax-free to the charitable organization of your choice. While we've got Steve unmuted, if anybody wants to be asking him any questions, as treasurer for all these years, he has made sure that Becky is as flexible as need be for people to do things like pay 2 years worth of dues, or send a whole list, as Steve mentioned, of this is for dues and shalach manot, and you can say that to Peggy months before she's ever even going to send out the shalach manot things. You just send a list, and she'll keep a tab for you. It's a wonderful personalized service that Becky offers to make it as easy as possible for you to support things at Becky throughout the year.
Right. And related to that, I because I see the financials, so I know what if we're not short of money, I just accumulate my bill until I'm ready to write a bigger check towards the end of the year, or whenever it is. So you don't have to necessarily prepay. You want to let Peggy know you're not delinquent. You're just, accumulating the bill to when you'll make one big IRA payment or one big stock payment later in the year.
Thanks, Donna. Harold, a question or some accounting advice for us?
Two quick comments. Okay. Number one, I think this was very, very well done. And explaining a very difficult area, of tax law. The only other quick question is, in all the comments, they talk about appreciated stock, and it should be known that if the stock has not appreciated, you should look into first selling it, taking the loss, and then then donate the proceeds. So that's why the word appreciated is used in all of the comments here. But otherwise, it's been very well done.
Thank you. For those who don't know, Harold's a CPA, so we're getting the highest compliment.
But it's also around the house, it's been referred to as constant pain in it. Well, never mind.
Jesse Palumbo, a question from you, Jesse, please.
I usually go to Harold for questions. Well, certainly Donna. Yes, interesting things about funds and QCDs. I've been talking to her DASA people about this sometime, and quite right, our names often don't appear on it. The organization where my funds are does not have a checkbook. It would have to come out of a donor advised fund. And so I've been doing QCDs. One year I was very annoyed and I had the QCDs come to my house. The problem with all those checks, including the Becky check, Federation, Hadassah, they came to the Hadassah, and underneath was my address. So several organizations wouldn't accept that QCD, and I had to have checks recut and sent directly to Hadassah rather than me. And they send it regular mail. They don't even send it overnight. So you have to be really careful. Every organization is different. My funds are with Oppenheimer and they are not flexible. So you have to, I've nearly lost checks various different ways. But in order to set up a donor advice fund, shall I see Lisa? Who shall I see? Lisa. I just come in to see.
Yes, but yes, you would see me about a donor advised fund, but you cannot currently use QCDs for a donor advised fund. The
Yeah.
IRS doesn't allow it. Okay.
No worries. No, it would be a rollover fund,
Right.
but I could roll over from an IRA, correct?
No,
An
you
IRA
No.
can't either. It would have to be
No.
capped.
But if you already know the organizations you wanted to give to, we can set it up so it's not a donor advised fund. So instead, you're sending the foundation a check and you're saying, I want you to, we're like a pass through, right? I want you to cut these 6 checks for 6 organizations. So this way you're only dealing with Oppenheimer on a single check. And then we're doing the disbursements. We could do that.
That's excellent. Thank you very much.
You're
I'll-
welcome.
So for any of you who aren't as savvy as Jesse about knowing what a QCD is, it's a qualified charitable distribution. And then, so what they were talking, the nuances of a donor advised fund where you take the tax benefit when you set it up and then you can dole it out over the years, versus when we were talking later during our conversation tonight about how when you can also take distributions from an IRA. Anyway, just to clarify that difference.
Well, actually, the QCD are the IRA distributions. And you can't currently make them to a donor advised fund, although we were talking about the difference between during your lifetime and not during your lifetime. During your lifetime, IRA only for QCD, not 401k, 403b. At your passing, IRA, 401k, 403b, and could include a donor advised fund as a beneficiary.
And the advisors
the
could be your
IRA.
children or I mean, you can set up really a family charitable fund with
Right.
relatively modest amount of money.
Think of it, you were going to leave your IRA to your kids. Okay, now there's going to be taxes. Well, maybe leave part of it to a donor advised fund with your kids as the advisors. So you're leaving them some money through the IRA and some money through the IRA, but as a donor advised fund.
Yeah, we actually did one of those and through the community foundation. We have other funds at the Jewish Foundation, but I figure my kids will have to get together once a year to decide how to do it. And I wish we were alive when that conversation happened so I could listen, but because they all have their own causes. But I just think it's a wonderful thing. And the way it was written up is they're allowed to choose their successor advisor. If this is going on for perpetuity, they can choose who. So I have 3 kids. There's always going to be 3 advisors, majority rules.
I want to
Andy.
wrap things up, but one other point I want to make is people have been talking about how different IRA different institutions that hold your IRA have different policies about how you make disbursements and how those checks go. Please know if you're with an institution that's going to send the check directly to that institution, and as Jesse found, if it's addressed to your home address, it might be hard for the charitable institution to then accept it. If it's going to go directly to Becky, Steve will correct me if I'm wrong, but if you just let Peggy know to watch for it, you can say a check will be coming from Oppenheimer. It'll be this amount. It's from me. Even if it doesn't have your name on it, we're blessed with Peggy who will keep an eye on it and will know exactly what to do with it when it comes. I can't promise that for Hadassah or wherever else Jesse wanted to send checks, but I can promise that for Becky. Margie?
Yeah, when I had my RMD, I also went to Peggy and I have Fidelity, but I made sure that they read back to me that they did put Becky and the right address and that it was from me on the memo. So, and I did see that when I checked my account. So they were
Fidelity will give you a free checkbook.
Fidelity will? Then
That's what I
calling.
use. And I write the
tomorrow.
checks right out of my Fidelity account.
Excellent. I'm going to call tomorrow. Thank you. That's really helpful.
Mhm.
Anyway, I think lots of tonight's program was helpful, and high compliment from Harold. And certainly I learned things, even though I thought I sort of knew what I was going to be asking about and getting in answers. Thank you to our panelists. Thank you all for coming. this is wonderful. We'll have Eric save it and put it on the website. So tell your friends that if they missed it, they really missed some helpful advice, but it'll be up on the website for people to watch at their leisure, or for us to watch again because we didn't quite understand something.
Or feel free to call me. Anybody who wants to, benefit Becky. That's my job. I'm finance chair, so I will help.
And you all know where to find me.
Or I know where to call you too.
Thank you all very, very much. Good night.
Thank
Hey.
you.